Hi, and good morning, good afternoon. I guess it depends on what side of the time zones you are. But my name's Glen Mather, and I'm the founder and president of NuView Trust. And I'm really excited about sharing this particular bit of information with you today. I'm planning on it to go for about 30 minutes, but we'll have time for you to throw in questions. So I would really encourage everybody as we're going through this, use your Q&A function on your screen. And we have staff here standing by to collect those questions, throw them up on my screen. And I'll try to get to as many of them as I can as I go through the process. But I want to make sure, of course, to cover the detail. If we don't cover it during my main presentation, there'll be time for questions and answers afterwards. So once again, welcome. And I hopefully at the end of the 30 minutes, there's going to be a sense, I think, as a retirement plan holder on some very unique things that you're going to be able to do that maybe you couldn't do earlier this year. You know, I founded this company 17 years ago to make sure that clients had the opportunity to have the broadest imaginable choices that they can have in their IRA while they're getting all the tax benefits of owning an IRA. That's what I was doing myself. And it was my supposition 17 years ago that clients would want to do that as well, and they certainly have, and this is in a long line of webinars and educational material that we bring to you on a weekly basis, and we're really happy that you're here to join us. So let's get started. I think you're all going to be relieved that I'm not an attorney or a CPA or a financial advisor, although they're great people and many of them are friends of mine. That's not what we do. We're actually serve as a custodian. We're not a fiduciary. We don't make recommendations, and in a way it's a safe place to be, because you're always not quite sure when you go into a store and you want to know how people are compensated before they sell you something, because what you want is you want someone that's going to be fair and open and honest. And as being your custodian, that's exactly what we are. Certainly you can talk to your CPA, your attorney, about anything that you hear today, and we would encourage you to do so. We end up getting a lot of calls and having conversations with people about our sessions and training, and we're certainly happy to talk to any of your advisors as well. Please go and consult with them about what you hear today. Now, don't be surprised that they don't know it yet, but soon they will, because you're gonna tell them. You know, our role is a custodian, and we hold the assets of over 10,000 clients, and about it's actually $1.5 billion now in client assets. And we've been at it for 17 years. Our headquarters building right there is NuView IRA. And you can see that little FedEx box there. About 20 or 30 documents or mailings go in that every night to be mailed out all over the country. People own all sorts of really interesting assets on our platform. And we're going to tell you about potentially how you're going to be able to do that too. So this is exciting. The trouble with employers' plans are this, and before I talk about the problems in the plans, let's talk about the good stuff. This is how America saves. We tend to save through payroll deduction, and it's probably because it's so darn easy. In other words, we never see the money. And the most important part is our spouses never see the money. So it's not viewed as spendable, it's not seen. And so this is what Congress actually intended back in 1975 when the first 401k was created. So the way it works primarily is the employer gets somebody to come in, probably from Wall Street, and create a 401k plan with them. Now, 401k is simply the title of the plan because it's the portion of the IRS code where all the rules and regulations are about the 401k plans. And they've been phenomenal. The way it works is generally you have to be employed to be a member of the plan. You can't take the money out, generally speaking, until you leave the employment. While you're in the plan, you may be fortunate enough to get employee or employer matches and employer contributions into your plan. That's always good. That's free money. And of course, you have to put in your plan contributions too for it to add up. Here's the biggest problem. Biggest problem is that you don't have much choice. And I'm told that the reason you don't have much choice is probably two reasons. Number one, that some Wall Street provider actually created the plan. So there's that pressure. The second thing is the legal pressure. What happens if you as an employee select the wrong investment choice? It goes under. Sometimes employees will actually file lawsuits against the company 401k plan, and no company is going to want to do that, especially if they're matching funds. So they say, let's limit the risk. And by limiting the risk, it also limits the choices. So most employer plans have anywhere from 6 to 8 investment choices, and that's it. And that's a pretty constrained way for you to save for your retirement. And for most people, this is going to be the most cash assets and investable assets that they have the rest of their lives. There's other things you can't do inside of it. You can't borrow money or leverage. You can borrow money from the plan, but your investments can't be leveraged. So for instance, you can't buy real estate with a loan. You're not allowed to do that inside a 401k plan. Generally, you're not going to be able to buy real estate at all. You're not going to buy any assets except stocks, bonds, and mutual funds. Generally speaking, the administration of the plan may fall within your HR company. Sometimes it's outsourced, but generally it's pretty slow. One really big drawback is if you want to take the money out. Now, some plans allow you to borrow, some plans don't. That's individual with each employer. But I'll tell you, if you take a distribution, you're going to pay taxes generally. And if you're under 59.5, you're going to pay an additional 10% before all the other taxes. So that's the penalty for taking it out early. So there's all these rules and regulations around 401k plans. And for the most part, they're good and they're legitimate. Bottom line is that the government would like you to keep it in the long term. They don't want you spending it. They don't want you blowing it. They don't want to take care of your retirement. They would much rather you take care of your retirement. So they've created all these tax rules for you to be able to get tax benefits when you put the contributions in, and you would get taxed generally when it comes out. There's a difference with a Roth, and we're not going to deal with all the different accounts today. Just want to understand how they work. And the saddest part is that I've talked to so many people after talking to them about self-directed IRAs and all the kind of wonderful things they can do. And they say, I'm on board, I want to do it, but I work at FedEx, or I work at Disney, or I work at a large company, and they told me that I can't take it out. I'm not allowed to take it out. The only way I can take it out is quit working there. Well, that's a pretty big sacrifice. And we're not suggesting anyone leave their employer to do that. This is what's exciting, because there are new rules about this. Now, a self-directed IRA, many of you may be aware of what that is and what it's not. I'm not going to spend a lot of time on it. But a true self-directed IRA means that you have access to all the choices that the IRS doesn't prohibit. And the IRS doesn't prohibit you from owning vast majority or a vast array of assets that you probably were not familiar with. For instance, you can buy real estate. You can certainly heard a lot about gold and gold IRAs, but there's other precious metals, so silver, platinum, and palladium that also can be held inside these plans. You can lend money. You can use your funds to help fund a business startup. You can do joint ventures, limited partnerships. It's amazing what people do. And I get to see it every day because we are the custodian of over 10,000 client accounts. So we see that what's going on, but we understand that the majority of people that work for a living are in their 401ks, 403bs, 457 in their employer plans, and they don't have access to this. The power of a self-directed IRA is immense. And the ability to buy things on sale when they're a lot lower cost and not have to buy them at market price. The fact that you could actually own a piece of property well into your retirement years, in this way, have your retirement protected against inflation. And we never know when that's going to come about. But also, most importantly, when you get older and you stop working, is you want your investments to create income for you. And many, many times, about 80% of the investments in Wall Street pay no dividends. So here you are older, you're going to have to sell your stock off to live. Well, if you own real estate and it's producing cash flow for you, you get to live off the cash flow. Who knows, maybe you pass that asset on to your children, or it gives you another thing to sell later on. So the opportunity to get all the tax benefits of an IRA, which are immense, together with the choices, is really the best place you're going to be. And so the reason that you've dialed into this call today is to learn about that. So let's talk a little bit about the CARES Act. Now, as everybody knows, we won't go into the pandemic, except for the fact that Congress actually the first time acted fairly quickly. They've had a real hard time with the second stimulus package. We all know that hasn't been passed yet. But with the CARES Act, there was lots of provisions in it. And the government was very aware that the average wage earner was going to face real difficulty. So there was some provisions in there. First thing that they did was this. They stated that if you're over 70 and a half, that you no longer have to take a required minimum distribution. Now, not many people on this call probably are over 70 and a half, but they were certainly affected by it. But the biggest opportunity out there of all is really the opportunity about the fact that you can take a distribution. And so what's happened is that the government realized that a lot of people's ability to be able to withstand the COVID environment and the economy was to be able to give them early access to their retirement without penalties. And that's what exactly they've done. So to anyone that's been adversely affected by COVID and the financial difficulties that it spawned, they're now allowing you to take a distribution up to $100,000. In other words, it could be 100% of what you have in your account up to $100,000. If you are under 59 and a half, if you did this before the CARES Act was passed, then you would have to pay a 10% penalty. The second thing that you have to pay if you take money out is taxes, and it's ordinary income tax. So for example, if you ordinarily earned $50,000 a year and that puts you in a lower bracket and you took $100,000 out, that would mean that you would be taxed as if you earned $150,000. It's a huge tax hit, and most people wouldn't do it because it would bump you into a higher tax category. So what happened is the Congress is now allowing you to do it different. First of all, there's no penalty. Second of all, they're going to take the income tax that you would normally have to pay for the distribution and spread it over 3 years. So you'd file, if you took it out, you'd have to take it out in 2020 because I don't know if I've mentioned it before, but this provision expires on December 30 of this year. December 30 of this year. So you only have about 50 plus days to do it. And so remember this as you're going through this, and you need to talk to your employer, and we'll talk a little bit more about that. So you go, well, that's okay, but I don't really want to take it out of my 401k. I don't really want to take it out of my retirement plan because I like the fact that it's growing, and aren't I hurting my retirement by taking it out? And I would say I'm right with you. As a custodian of IRAs, I never advise people to take it out. But what I'm trying to explain to you is through actually following the rules of this, what you may be able to do is actually recontribute the distributed amount with a self-directed custodian such as NuView. And now you can actually transfer that money without tax implications from a very restricted employer-based program run by Wall Street executives now into a plan that's run by you. It'll be truly self-directed. This opportunity has not existed in the last 45 years since 401ks have been created. So understand how impactful this is. Now, are there rules about it? Well, there certainly are rules. And what I want you to understand is that the first thing is you're getting the tax benefit of being able to take it out early. You're not going to pay the 10%. But there's rules and regulations that you have to follow. And you each have to determine whether or not you qualify for this. But I'll have to tell you that the IRS came out with the rules when the CARES Act was adopted, or I think it was around March 27th of this year. But they've since broadened it. So feel free to go to the website, and we actually have more information available to you at the end of the day. Or at the end of this presentation that you can go take a look at. But it's not hard to kind of figure out whether or not you might qualify. So when the original rules came out, this is basically what the IRS said. It has to do with your qualification. And so largely it can be something that you've experienced, some financial hardships that you've experienced, or financial hardship in your household or your spouse may have had. If someone got laid off, if they've been unable to work because of childcare restrictions, if they've had to reduce hours in a business that they were running. All of these things you see listed on the screen. There's actually more that are later rulings that we'll be able to send to you at the end of this presentation. So understand what this opportunity is. It's an opportunity for you to roll your money over, or actually take a distribution from your plan. And that triggers some tax liability for you, understand, for your future taxes on your distribution. That's spread over 3 years. If you were to recontribute that back to a self-directed IRA such as NuView has, then especially if you were to do it in the same tax year, there'd be no additional reporting at all. If you were to do it in a future tax year, any taxes that you've already paid for that distribution would go away because you actually have 3 years to do this. Now, even though you have the capability of keeping that money for 3 years, it's much better that it earns money in a tax deferred place, because you're going to have to pay tax on any earnings. If you were to take it out and go invest it, the only amount you could put back in is the $100,000. You couldn't put back any of the gains. You'd be taxed on the gains. So the real opportunity that I see is the fact that you can stair step from a very restricted plan into a plan that allows you to do anything the IRS doesn't prohibit, but you don't have to exit your plan. So all of your future contributions going in, and any employer matches that you get, and any benefits to borrow from it, and all that's wonderful aspects of a 401k, you still have. But what you've been able to is move over all of those earlier savings into a place where you can really, really drive your own gains and your own growth on your own terms. Does that make sense to everybody? Okay. And this isn't advancing, so our slides aren't advancing right now, but we'll get there in just a minute. And what I'll go ahead and sort of explain to you, that you have to make these elections yourself. It's a very easy process. You're going to go back to your HR department and ask them if they're offering this distribution option. If they say no, I think my next question would be, why not? And they may not have heard about it. They may not have had anybody request this before. It's okay to be a pioneer. I'm used to being a pioneer because I self-direct my IRA, and I did that about 20 years ago, and not everybody did it then. But I will tell you something: talk to your plan administrator and get and make sure that this is available to you. And then you're going to ask for distribution, but make sure it's a request that's based on the requirements, one or more of the requirements listed in the CARES Act, right? At that point in time, you can open up an account with NuView Trust. And then what you can actually do is you're going to write a check back. It'll be in your checking account because you've taken the distribution. You're going to write a check back to NuView in the name of your IRA. And now you're going to have your IRA, instead of being $100,000 or less in your employer's plan, you're going to now have $100,000 or less at your NuView account. And now you're going to be able to self-direct. So the key here to make it easy is to roll over your funds as soon as you can, and so that roll it back into a plan, so you're not going to have to pay taxes and then have to file for a tax credit next year because you put it in within the 3 years that you were covering it. And I'm not sure if anyone's asked any questions yet, but I'm certainly willing to take questions in regards to what the possibilities are. And I'm seeing a few come up right now. And someone just asked, how does a self-directed 401k plan work? And what are the benefits between a self-directed 401k plan and an IRA? And really what we're talking about doing is moving it from a 401k to a self-directed IRA. So when it gets moved over, it changes characteristics. It goes from a 401k plan and all the rules and regulations associated with that employer plan. When it comes over to NuView, it's an IRA and it's subject to IRA rules and IRA plan rules. And the nice thing is it's a very close similarity between the plans. And of course, with an IRA, you don't have to be an employee of anyone. It's just yours. It's called an individual IRA. It goes with you no matter what employer is, where your employer plan actually is only with you as long as you keep working there and take a distribution. So the fact that it's self-directed is the huge kind of like mind-blowing aspect of all what you can do inside of it. Now I have a second question from Bruce, and it says, I am 64. Well, first of all, Bruce, congratulations, because I'm 64 as well. I don't usually tell everybody my age, so we've got some commonality here. Here's the question. Can I take $100,000 out of my 401k and put it in a NuView Roth and spread the taxes over 3 years. Well, what you're talking about is you're mixing two ideas. And so let's take them one at a time. First of all, if you move over your $100,000, and I assume it's inside employer plans, you might have some Roth money inside. Most people don't, but you could. I'm assuming, Bruce, that you don't, that it's in a pre-tax contribution and earnings. So are you saying, can I put it into a NuView Roth and spread the taxes over 3 years? Well, you're not going to be able to do that. And I understand what you're saying is what you're talking about is doing a Roth conversion. And that's taking pre-tax money and converting it to a Roth where you'll never be taxed again, and you'll never be forced to take distributions. Roths are wonderful. Unfortunately, this doesn't make a provision on how you can save taxes on making that conversion. One thing that I always talk to people about making a Roth conversion is if your earnings are up and down, always make your conversion in your lowest earning years so you're not bumped into a higher bracket. But the CARES Act doesn't really give you additional power to defer taxes when you're making a distribution. So thanks for the question. All right, I've got Karen asked me, I'm now self-employed. I have an old plan that's part of an employer's 401k. I only had a few months of reduced income and not sure if that really qualifies because I still worked some. Does it qualify as a hardship? Well, I'm not here to tell you what qualifies as a hardship. It's more of a self-declaration. And, I'm not going to get into a sense that you should mischaracterize anything to the IRS, but it's really your declaration whether you hit a hardship or not. And the other thing that I would point out to you, Karen, is in addition, you may be qualified because you're self-employed now. You may qualify with a NuView Trust solo 401k, or it's called a QRP. And that may be a great program to roll into instead of being in an IRA because you're self-employed. You could actually roll that into a solo 401k with NuView. So that might make a lot of sense too. And I would ask these, obviously I'm answering these very quickly without context. Please call us back at the office. We'll be glad to go over the questions as they relate to you, but please do it quickly because of the end of the year. I've got a REIT, I believe it is. So I can't quite read it. Year end. I'll tell you what, if a REIT, if you could restate your question so I can understand it. It's written in shorthand, so I don't quite get it all. Next, we're going to move to Joseph. It says, clarification, the CARES Act allowed withdrawal applies if you're under 59 and a half. If you're over 59 and a half, you can take a distribution as much as you want, anytime you want from the 401k and put it into an IRA through an indirect rollover. That was a question. And yes, Joe, this is what we're talking about. In correct terminology, it would be considered an indirect rollover. However, it's really not right either because you're really taking a distribution. You are taking a distribution under the rules and regulations of the CARES Act. And what you're doing is sort of making a new, I call it a recontribution back into your account with NuView. And the 59.5 simply says that you don't have to pay the 10% penalty. It's the fact that when it's in an employer's plan, even if you could, the employer plan generally won't even let you take it out at all. But if you do, it's 59.5. CARES Act allows the employer to let it go and also not charge you that 10% parting gift when you remove it from your account. And another question says, if you were 60, which one would you open? A Roth or a traditional, or Roth? They asked the question, a Roth or self-directed, and just to be clear, self-directed has nothing to do with a Roth or a traditional, a SEP or simple. It's all self-directed if we're the custodian. So all the rules apply on those. Whether you should own a Roth or not, oh man, that's time for another webinar. And I will tell you how I feel about it. I'm 64, and I've just about converted all of my retirement to Roths. And the reason for that is I don't really want to get into my 70s and 80s and have the government dictate that I have to take mandatory distributions. I don't like it. I love the freedom that I can take it all if I want it or take none of it. So my recommendation for myself would be to open a Roth, but either one is based on, and really what you would base that on is how much money you're expecting to earn in your investments. And the higher the money is, then then I would convert, because you're saving taxes on all the benefits or the distributions you're going to get from those investments later on in life. And you know, at 64, I kind of feel like I'm going to live till 95 at least. So to me, I'm just getting in the started at the end part of my life. So it just depends on your viewpoint, and honestly, it depends on how long you plan on living. And none of us can probably figure that out on the web. But is it wrong for you to do that? Well, you're paying taxes when you make the conversion, so you've got to decide whether you want to pay those taxes or not, and you've got to get the earnings on the other side to justify it. All right, okay, I've got and I'm trying to tie all these together, Arit, so I'll do what I can. And I've got actually it says, my question is on the timing of withdrawal and recontribute and the tax implication. So let me see if I can do this. I think the question says, so if we withdraw before year end 2020, hey, I'm doing good so far, up to $10,000, but redistribute it back to the self-directed IRA before year end 2020, no tax penalty. That was as a statement, and that's correct. But if we recontribute in 21 or 22, do we have to pay tax for the 2020 but claim credit in 2021? You know, I'll tell you what, would you do me a favor, because I'm a little twisted on this, and would you call us at the office? I would ask to do that. That's a little bit, I'm not quite sure what your question is on that. Let me just strip it out and make the simple part of this simple. The way it works right now with the CARES Act, you can take it out. You have to take it out before December 30. You can put it back in before December 30, 3 years from now, which would be what, 2023. If you put it in back in, then you will not have to pay any taxes or penalties. So in other words, all the taxes that you've paid, the 3 years worth of taxes that you've paid over the course of splitting it into 3 payments, they'll all be credited back to you. This should have nothing to do with future contributions and what you're putting in the plan. Karen's asking, if you roll over to a self-directed IRA with NuView for the purpose of purchasing real estate in another country, are you not able to live in that property as is considered only an investment and not a primary, secondary residence? Oh my, that really doesn't have anything to do with what country it's in. This has to do with the rules around self-use. So your IRA is never allowed to benefit yourself, and living in it is considered one of those prohibited things to do, because you're benefiting yourself by living in it. And it wouldn't matter if you paid rent back to your plan and everything. That's not allowed. It wouldn't matter the location of it. There's actually, it's interesting, but Karen, there's actually a way that you can do this, but it would mean buying it as a Roth, holding it for 5 years, and then you could actually take it as a distribution and live in it. But as long as it's in an IRA account, you're not allowed to live in the property that's owned by your IRA. So I think I've got all the questions so far. And if we can just move on, I'm going to move on to the end of this. And I want you to understand that we've covered this relatively quickly, and everybody's situation is slightly different. But I want you to go to your employer first. As far as if you're in the situation and you'd like to get this money out, go to your employer first and ask for a CARES Act distribution. And then you'll find out whether you're the first on the block to do that or if they've actually done this before. And you have to be patient with them. If you have any problem or issues with this or how it works, you can certainly give us a call, and we'll give you as much hand or advice that we can give you on how that works, because we've certainly had clients that have done this. And if you just contact us at what you see on the screen, and we'll be able to send you that book. You see our number on there, and if you don't see it on our screen, it's 407-367-3472. There's people here right now that'll be able to help you specifically with this. And your e-guide is kind of neat, because not only it'll tell you the steps that we've talked about in this webinar, but it'll also give you the code. It'll also give you what the CARES Act actually says. So if you want to read through the whole thing, feel free to do it. We've only grabbed that piece out that pertain to this conversation. I just got another message in, a question in from Bruce. And Bruce says, can I invest in a solo Roth IRA, and is it advantageous for a normal Roth? And I'll cover that. I think we're mixing a few of the names. We talked about a solo 401k plan. So that's like a solo employer plan if you are self-employed. And that's one type of plan. The Roth is a Roth. So no matter what kind of Roth you have, it's a Roth IRA. The big difference is most companies won't allow you to self-direct it, and that's what we do. So all the rules for all these plans are the same, no matter what custodian, whether you're Charles Schwab or whether you're here. It's just that the choices are much more constrained. And I love this. Bruce is telling me I'm retired. My only income is off 22 rental properties. How many out there would like to be retired with 22 rental properties? I know it's a lot of work, but it's a different way of getting income, certainly than some other perhaps more risky things. I have $700,000 in taxable 401k and plan to put $100,000 a year into Roths till I take my pension and Social Security at 69. I'll be in a higher tax bracket in the future, and I'm in my Goldilocks years now. I love that, the Goldilocks years. I would assume that's right in the middle, right? It's not too high and too low. That's a great plan, because I love what Bruce is saying. Bruce is saying, I plan on being in a higher tax bracket when I retire than I am now. Most people and most financial planners would tell Bruce, well, what we should do is you don't worry about putting in a Roth, because you're going to take distributions out and you're not going to be earning much in your future years. And I think this is what really changes perspective, is our clients really think different. They think like Bruce, which is, I plan on having a really good income when I get older. So having a Roth means I don't pay taxes because I'm going to be earning more in my senior years, as they call it. So I'm not thinking like a traditional planner, and our clients don't. So Bruce, thanks for that. That's a great way to end the presentation. Once again, you can contact us this way. You can contact us at NuViewTrust.com. And really thank you for being here. And please take a hard look at this and take advantage, because it's about to shut doors in about, 55 days. So God bless everybody. Look forward to talking to you again soon.